Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital.
I'm Chad Sheeler, founder of Focus Capital.
Welcome back, Chad. You look nice and refreshed. We had Chad Olson on in the past 2 weeks, and it was really good to get really on the technical sides of things, especially when it comes to stress testing deals and looking at market analyses. Something that I wanted to kind of jump into right when you got back is getting to understand something that's critical for passive investors, but is not always easy to understand at first, and that's the GP-LP alignment. So, because at the end of the day, the structure of a deal determines who gets paid, when they get paid, and how incentives are aligned. So, if we were to start super general, let's start with like basic terms. So, what do we mean by GP and LP?
Yeah, GP being general partner. That'd be the person who operates the deal, finds the deal, raises the capital. They're the ones that are in charge. Right? They make the decisions, they have voting rights, and they perform the asset. And the LP is a limited partner, and that's the passive investors, a group of them or a few of them who have decided to invest in the property passively, to where they do no work at all. They review reports, they have distributions, hopefully. They participate in the profits of the sale as well.
Yeah. And I think it's important for people to note that sometimes there's a single GP and multiple LPs, and then sometimes there can be some co-GPs. So if there's a bigger deal, let's stick to real estate, because there could be, GPs of all different types of funds. But within the real estate side, if there's a bigger deal that we believe that, would be easier acquired and beneficial for all LPs involved to partner with another GP on that, there can be other GPs involved in the deal as well. How does that work typically, though, from a basic level on a GP split?
Yeah, I think a couple things there. So ideally, the deal has one GP, right? Mm-hmm. You have the operator, the sponsor, they are the one GP. And that's how a lot of deals are done. A lot of our deals are done as well. I think you got to be careful when you've got a deal that might have, 5+ GPs in there. Mm-hmm. Maybe there's questions there as far as what are they actually all doing? Who's the guy in charge? And if there's other GPs involved, co-GPs that maybe are helping raise capital or helping with asset management, or maybe they help find the deal, those all can be valid points, right? That's okay. I think what's most important there, though, on the GP team is that you've got one person who really holds decision rights, the voting rights, the same control, and that one is the majority person on the GP. So that's my take on GPs there.
Yeah.
And about splits, go ahead and go to that part as well.
Yeah, I would say from a split perspective is because when we're going to get into, and maybe we'll save this for a little bit later in the episode, but we talk about how GPs get compensated. Yep. We're not doing it for free. I don't think that there's any, miscommunication there that there's a way that GPs make their money and there's a way that LPs make their money. But before we go into that, we'll pause that for a second, but let's talk about alignment first. Why is alignment between, let's just keep it simple, one GP and then their LPs, why is alignment between the two of them so important?
Yeah, you've got, and we'll pin that apart as well. That's good to touch on actually. But the line between GP and LP is so important, because here's what could happen. Like, if there's not alignment to where maybe the GP is incentivized to make different decisions that would not be in the best interest of the LPs, maybe because it gives them their payday sooner, or it gives them more money up front. Like, you've got to make sure the incentives are aligned. So one good way to measure that is looking at, all right, the GP needs to make some money up front, right, to support the team, because last thing you want to do is be compensating a GP less than you should on a deal that you hope to run really well. So the point is, they should be able to have the payroll and the staff on site in the business to be able to run the property to its max potential. What's that take? It takes payroll, right? Mm-hmm. So there should be this compensation for the GP up front that's appropriate, that's fair. There's other areas to look at to make sure we have great alignment would be, all right, well, who gets the money first, right? Well, the GP probably shouldn't. They're putting money in, hopefully they are, of their own money, and they should be an LP alongside other LPs too. Same playing field there. But normally there's either a straight split of cash flows, let's call it 80-20 or 85-15, LP GP, or there's a preferred return model like we discussed, a couple months ago, to where the LPs have a threshold to where they're not guaranteed, but they get the first ratio of the returns to them, the first priority of returns to them, and then we can follow a split down the road. So what that means is the incentives alignment there is great because that makes sure the GP has to do their work to get paid down the road. So making sure the LPs get some money first before the GP is paid at all.
Yeah. Let's talk about kind of like how GPs get paid, because we talk about how incentives, especially monetarily, need to align to just kind of have that extra level of assurity for LPs and GPs alike. We talked about acquisition fees, asset management fees, promote or carried interest, and disposition fees. Those are all ways that GPs typically get compensated. I wanted to double tap into something that you had just said about there is some upfront compensation that's necessary to run and operate a property or an asset. Where does that timeline usually happen, like different points of compensation, and why? And why is that important? Because I think that there are a lot of Instagram and LinkedIn posters out there that are like, hey, if GPs get compensated up front, that's a red flag. And I don't think that's wholly true. And context definitely applies.
Yeah, it's a great point actually. I've had the chuckle internally when you said this actually, but the GP should make a fee up front typically on the deal, and usually you have to look at what the percentages of the total purchase price. Typical ranges I'm seeing are between 1.5% to 2% typically. That's pretty typical. We're at 1.5% most times. And it's not a big fee. I mean, comparatively, if you do a couple deals a year, I mean, that's just enough to kind of probably break even for your business. But they need to have a fee up front, because if they don't make any money to cover their overhead, then how are they ever going to have the best payroll people to be able to run the property the best way? If you don't pay them at all, you can't run the property to its fullest. So it takes money to do that. And you can't expect the GP to come out of pocket for 5 years to pay for these salaried people and bonus them before you get paid, hopefully out of sale, right?
Yeah.
That's why the fee up front is needed. Now, you got to watch out, because there's some deals out there I've seen where there's a higher percentage fee up front on acquisition, and that's probably not appropriate. Maybe 3, 4, 5%, and that's not standard. So maybe it's more like knowing what is market standard for these different fees.
Yeah. And then when it comes to is there outside asset management fees that are typically part of a GP structure, or is that part of the upfront acquisition fees that are built in?
No, the upfront fee is just one fee. You might have a loan fee in there for a loan guarantee fee. That's pretty common as well. But as far as asset management fees, those are paid monthly or quarterly from the effective gross income of the asset once it's producing cash flow.
And then let's talk about promote and carry, because then we can kind of go back into when you're a co-GP on a deal versus a singular GP. What does that even mean to people that have never heard of those terms? Yeah,
promote and carry is essentially, once in the preferred return model, right, that the investor, you limited partner, you're going to get a preferred return. You're entitled to the first, let's call it 8% return on your capital, right? You get your 8% back. Beyond that point, we're going to split the remaining cash flows and profits with the GP. So split from LP GP may be like 80-20 or 70-30. That means 80% of additional cash flows beyond that point would be split with the LP, remaining 20% go to the GP. So the GP is really working really hard in those early months to get your preferred return paid in full back to you, so they can get a split as well. So they can all get cash flow. So that, I think, is really a good way to structure incentives and have them alignment properly.
Yeah, I think that a term that a lot of people are familiar of, if they have done any type of investing or read any investment books, is alpha. And what we're really trying to get to is it's really that alpha that we're splitting. And that's where the extra incentive is that if we are predicting or modeling that this property is going to get to X, value, anything above and beyond that, like there's definitely some incentive in there, because you're going to get some extra cake too. But then also we had that extra split as well. And so everyone's incentivized for that to go that way. But then, markets are things that we can't control. And so when we talked about underwriting with the other Chad last week, we still underwrite conservatively enough that we can still hit those markers. What does good alignment between GP and LP look like in practice? One point that you had already said, a good example of that, is that a GP invests their own capital. That is, it's mutually assured destruction on the negative side, but mutually assured benefits as well. It's like if your GP is investing alongside of you, obviously they see something in their own deal. Other things that we talked about are performance-based upside, and LPs get paid first. But we talked about how real estate is a long game, and that a lot of these returns have a long-term focus. Most LPs that have maybe a lack of education are more concerned about upfront cash flow than the long-term focus. And so we have talked about in previous episodes how GPs control cash flow reserves, especially when it comes to loan amortization, any reserves that they need for property maintenance. And so how do LPs kind of secure themselves in knowing that if something is not distributing right away, that doesn't mean that they're not getting paid first, or that any of the cash flow coming from the property is just going straight to the GP? What are things that they can look at? What are red flags or green flags that they can look at when that alignment comes into practice?
Yeah, those are all great points, Jared. I would say the first one kind of being, what's skin in the game being one way to measure alignment. The last point being, okay, reserves, question about that. We'll pin that for a second here. But yeah, I think skin in the game, I feel like that's probably the biggest one. Like if the GP is willing to put up his own money, his or her own money, 10%, 5%, 10% plus, okay, they have skin in the game. If they have put up 20% or more, like if things go wrong, like they're gonna hurt pretty bad. It's gonna be pretty painful. So like what's the odds they'll put forth the extra effort to ensure it goes well? And I think showing that a GP has skin in the game is probably one of the best ways to show alignment. That's why I've always done it myself in every single deal. I believe in that personally. And kind of touching back on the promote piece, there's some times where there may be an extra incentive down the road if we over exceed the business plan to where the GP may get an even better split on that additional gain. And there's different schools of thought on this. I actually like it because if you invested in a deal that was going to be projected at certain returns and you plan on that or hoping for that, right? And if the GP blew out of the park, part of me does feel like, well, they probably should get rewarded for that. At the same time, investors will get still paid as well, get a lot of the upside. So everybody's look at that, of course. But then the last piece you mentioned there was on the reserve. So pretty simple way to do that would be look at their quarterly financials. Hopefully their GP sends those to you every quarter. On the balance sheet there, you can see financials with the balance sheet, with the cash in the bank, reserves. That is a big point to make actually, because you don't really know as a limited partner, transparently, you'll see the bank accounts, you'll see financials every month. The GP could be siphoning money off. They definitely could. But I think it's important to make sure as an LP that you get invested with a GP or sponsor that has a great CPA firm or third-party bookkeeping firm that is really doing the checks and balances for them on these properties and assets, to where and review reports every quarter to where you can see plain as day, okay, there's those reserves in the account, there's cash in there. I may not be streaming right now, but there's cash coming in, it's in the account.
Yeah. To your earlier point about getting extra incentives for above and beyond performance, like that's a typical hedge fund model to get paid a management fee, an asset management fee for managing your assets. Then they have a performance fee. So typically, if we want to talk about like the 2 and 20 and 80-20 split, 80% goes to the investor or the person whose capital they're managing. So there's the 2 and 20. I get 2% to manage your funds. Then I get the 20% of all the performance-based fees up to, if I promised you a 15% return, then I get 20% of that. Everything in abundance to that is a 50-50 split. And so those are pretty typical terms with any type of investment. Real estate is just another one of those things where there's actual hard collateral involved from an equity perspective instead of just a public markets or even, from a VC model. Let's talk about the downside. So when misalignment happens, where do you see things start to break down, and what are most common alignment issues that you've seen in the industry?
I think misalignment, well, first obvious one is like, okay, what portion of the GP's overall compensation or potential compensation is coming up front? Mm-hmm. Meaning like, well, how much they're taking as a fee up front?
Yeah.
If their total GP comp is $2 million on a deal, and they get $1 million up front, that's probably misalignment, honestly. But that's probably why it's important to know what are the fair market averages for these things. If there's no skin in the game, no money to put in the deal at all, that's a red flag to me. Like, I would never invest my capital with a GP who didn't put $1 in himself. Never would do that. If they don't believe in the deal, why should I, right? Misalignment, I think that having the GP get a substantial amount of pay along the way before LPs do would be misalignment as well. But I really kind of go back to the first 2 points I made were probably the biggest 2 points for myself. Like if there's a large fee up front they make that's abnormal, that'd be a big red flag of misalignment. The skin in the game, misalignment, that's one too.
I think the two things that I would probably add on to that as someone who runs like the investor relations side of our business is in all of our, if our incentives were tied to volume instead of performance. So like you were saying, it lends to that, like, are we making a majority on on an acquisition fee? So we are incentivized to add 10 properties into our portfolio no matter what the return is, because that's where a majority of our compensation comes from. So making sure that we tie our incentives to the performance side of things and not the volume. And that's why we might only do, 2 to 3 deals a year, where some of these other funds are doing, 6 or 8 deals a year, but they're not performing nearly as well. And that's how they still stay open. And then also short-term decision making. Some of our investors like realize and are being educated kind of through our model that a lot of these things have long-term focuses. So going back to the cash reserves thing, reserving cash for any type of property maintenance, but also for loan amortization and all these things. And so when you see an operator operating with not a short lens, but a long focus lens, those are areas that you can look to see if there's going to be any misalignment. So someone who's short-term decision making, they're only kind of doing this in the near term because they're trying to hit certain X points to get their incentives.
Yep.
Another big mistake that I think investors make when it comes to evaluating alignment, so not even from a misalignment perspective, but just evaluating alignment, is focusing only on returns. I think that there's a big focus on IRR versus cash flow versus this. I think that outside of returns, you should focus on structure, because you could have this big percentage of returns, but what's the structure of where that return comes from? Because 100% of zero is still zero. That's an extreme case, but like, don't just look at that 100% number. Look at the structure of how your returns are given to you, not just from a timeline perspective, but also from a percentage perspective. And then also just not understanding in general how GPs get paid. And that's a main reason for this episode, is a lot of people don't understand how GPs get paid, because a lot of other investing criteria involves you paying a fee on top of investing into it. And it's very clear there how the asset manager or financial manager or whomever is getting paid there.
Yeah, I pause you there for a second. I think it's important for people to know, as a GP, they do stand to make potentially a good amount of money on a property if they do a really good job for over the next 5 to 10 years. Yeah. And that's the key point there, is this is definitely a long game, just as it is for the LPs. We're all in it together, but the LPs get paid before the GPs with their investment, basically. But I think they have to remember, like, what all the GP does for the next 5 years, doing all the work, asset managing the asset, day in and day out. They guarantee the loan, both the balance sheet, there's risk there, and they have to pay for a team. So to go bring these investments to the LPs. I think it's important to understand what all kind of work they do and why a GP gets paid the way they do at the end of a sale, which should be the majority of their, compensation, hopefully, right? That's what we're all working for. Otherwise, why are we doing this, honestly?
Yeah. And when it comes to governance and transparency, and this is kind of more in my field, definitely here from a departmental standpoint, is you had touched on it, like the quarterly financials. We have 2 different reporting cadences. We have a more anecdotal cadence when it comes to our monthly reporting. So for every one of our properties, they'll get 12 reports, and that's usually 2 KPIs when it comes to tenancy and all of our occupation there. And then we also report on any updates that were made, stuff that happened in the past 30 days, and what is going to happen in the next 30 days. Our quarterly updates have all of those more robust financials. And that's where a lot of the governance and transparency comes from, because you're right. In the beginning, a GP has all the control of an asset. And that's a good thing for passive investors, because if you have a trusted GP, then you can truly be passive. I don't have to have my hands in on this property. I don't have to make any decisions. But that can also be, the flip side is, if you're not with a trusted operator and they have all the control, like, you're trusting them with not just your money, but everybody else's money and the asset that your money is backing. So having that decision-making authority, looking at the legal structure of where those agreements are coming into place, and then making sure that your operator / GP is giving you the cadence that you need and is appropriate. Like, I'm not saying daily or weekly, but an appropriate cadences are definitely green flags when evaluating an operator.
Yeah. That's the question to ask up front too. Like, when you're vetting questions, so, all right, what's your reporting process like?
Yeah.
What's your communication process like? I think you'll see some great alignment signals there by understanding what their process is.
Yeah.
Like, if they report out, we report out twice a year. well, maybe that's not as good of alignment as it should be. Maybe it's once a quarter at least.
Yeah. And then I would just say that like when investors are looking at evaluating a deal and a GP, like the numbers matter, but the structure behind the numbers is what matters more, because you're not just investing in the property, you're investing in the structure. Because this is why, passive investing has a little bit more into it than some people think on the front side of things versus, active investing, is because that structure is just as important, if not more important, than those numbers that you're looking at from a returns perspective. So if you're investing passively, understanding the GP and LP alignment isn't an option. It's one of the more important parts of evaluating a deal, and the person writing the deal is kind of like where I would leave our listeners with.
Yeah, I agree. I mean, investing in the operator is probably the most important part. It's all about the people. It's all about people everywhere. It's people at our properties that affect the performance. It affects the investors, and all kind of starts with our people in-house here with the operator team. Better we are as employees and great people we have on site, we can then lead the properties better for investors.
And even if none of these numbers or structures make sense to kind of like a first-time LP, the one thing that has been consistent across all of our messaging, across all of our episodes, is transparency. If you are evaluating an operator, even before the deals, even before the returns, the IRR, all of that, if you can find someone that you can trust and is being transparent with you and you can ask questions to, the rest of this will just come along with it. You can ask them, the right question to ask. How do you get compensated? And if that feels like an uncomfortable question to ask, then there's probably not the level of trust that you need with your GP at the time. So
yeah, I agree. That was great, Jared.
Perfect. All right, see you next week.
See ya.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.